Hi everyone, and welcome back to Bowdie Shorts, making law make sense in 15 minutes or less. Now, in the last episode, we looked at personal claims against trustees, and that was all about compensation. If a trustee breached trust and caused loss, the beneficiaries could sue the trustee personally and ask, can we make the trustee pay? Today, we move to a different type of claim. Instead of chasing the trustee personally, the beneficiaries may be chasing property, and that brings us to proprietary claims. And today's key question, can the beneficiaries get the trust property back? Now let's start with the basic distinction between personal claims and proprietary claims. So a personal claim is against the trustee. The trustee pays compensation from their own money. A proprietary claim is different. A proprietary claim, as the name suggests, is against property. The beneficiary asks that asset belongs to the trust. It should be in the trust. So instead of asking the trustee to pay compensation, the beneficiary is trying to recover specific property or property that represents the original trust property itself. Now, why does this matter? Well, a proprietary claim can be much more powerful than a personal claim. Why? Well, because personal claims depend on the trustee's solvency. If the trustee is bankrupt, a personal claim may be practically useless. The beneficiary becomes just another unsecured creditor. But if the trustee still holds trust property or something bought with trust property, that property does not belong to the trustee, it belongs to the trust. So it does not form part of the trustee's bankruptcy estate, and that makes proprietary claims extremely valuable. So when is a proprietary claim useful? Well, a proprietary claim is useful, especially in circumstances where the trustee is insolvent, the trustee has bought an asset using trust money, that asset has increased in value. The personal claim may be time barred, or the beneficiaries want the property itself. But there is one crucial limitation. There must be property to claim. If the trustee has spent the money on holiday, gambling, food, debts, or general expenses, then the trust property may have been dissipated. And if there is nothing left to identify, then there is nothing to recover through a proprietary claim. Let's look at a few different scenarios, starting with the original trust property. So the simplest case is where the trustee still holds the original trust property. No tracing is needed. We'll get to tracing in a moment. The property is still there. For example, if trust land is wrongly put into one trustee's sole name, the beneficiary can require that land to be restored to the trust. Now, the claim is proprietary because the beneficiaries are asserting rights over the property itself. We're then going to look at substitute property. Now, more commonly, the trustee has changed the form of the trust property. For example, the trustee takes £20,000 from the trust account and uses it to buy a painting. The money has gone, but the painting now represents the trust money, and this is known as clean substitution. The trust property has simply changed form. Money has become a painting. So what can the beneficiaries do? Well, the beneficiaries usually have a choice. If the new asset has increased in value, they will likely want the asset. So if the painting had been bought for £20,000 and is now worth £25,000, the beneficiaries will claim the painting and the trust will get the benefit of that £5,000 increase. If the painting though has fallen in value, the beneficiaries may prefer a personal claim for the original £20,000, and then they can take something called an equitable lien over the painting as security. That way, if the trustee cannot pay, the painting can still be sold to help to satisfy the majority of the claim for the sum that has been dissipated. Now let's look at mixed assets, and this is where things tend to become more complicated. So what if the trustee buys an asset using a mixture of trust money and their own money? So for example, the trustee takes £10,000 from the trust and adds £5,000 of their own money to buy shares worth £15,000. Well, that asset is a mixed asset. The trust contributed 2/3 of the purchase price. The trustee contributed 1/3. Now, if the asset increases in value, so if the shares rise in value to £24,000, the beneficiaries will usually want a proportionate share. The trust contributed 2/3 of the original purchase price, so the trust claims 2/3 of the current value. That would mean in this case that the trust claim would be worth £16,000. If the shares fall in value though to £12,000, the beneficiaries may prefer a personal claim for the original 10,000, supported again by that equitable lien over the shares. Again, equity tries to give the innocent beneficiary the best available result against the wrongdoing trainee. Now, the most difficult tracing problems arise where trust money is paid into a bank account containing other money. So suppose a trustee pays trust money into their own bank account. That account already contains personal funds. The trustee then makes withdrawals, and some money is spent and some money buys assets. The question becomes, which withdrawals used trust money? And to answer that, equity uses what are known as the tracing rules. The first tracing rule is associated with the case of re Hallett. And the basic idea is the trustee is presumed to spend their own money first. And this is helpful where the early withdrawals have been wasted. For example, if the trustee pays trust money into a mixed account and then spends money on personal debts, equity may presume that the trustee spent their own money first, and this leaves the trust money available to be traced into later assets or into any remaining bank balance. Now, why does this rule exist? Well, because equity presumes things against the wrongdoer. So a trustee is the one who mixed the money. The trustee, therefore, should not benefit from that confusion. So equity interprets the situation in the way that best protects the beneficiaries. But re Hallett will not always help, and this brings us to the case of re Otway. So suppose the trustee first uses money from the mixed account to buy shares, then later dissipates the rest on credit card debts. So if we rigidly applied re Hallett, the trustee would be treated as spending their own money first on the shares, and that would leave the trust money being dissipated, paying off the debts. And that would benefit the wrongdoing trustee. And as you can imagine, equity will not allow that. So another rule applies, the rule in re Otway. Under this rule, the beneficiary can claim a first charge over the mixed fund or the property bought from it. So in simple terms, the beneficiary gets first choice. They can trace into the asset that gives them the best result. Now, when trust money is mixed with the trustee's own money, always remember that equity tries to protect the beneficiary. The trustee is the one who created the problem. So the tracing rules are applied against the trustee and in favour of the trust. There is, however, an important limit. A beneficiary cannot trace into money that was never trust money. This is where the lowest intermediate balance rule comes in. So suppose a trustee steals £40,000 and puts it into a mixed account. The account balance later falls to £2,000. After that, the trustee receives £3,000 from an alternative source. Can the trust claim the full £5,000 balance? Well, no. The trust's claim is limited to the lowest balance the account reached before new money was paid in. Here, that is £2,000. The later £3,000 did not come from the trust, so it does not automatically become trust property. Now, so far, we've considered trust money mixed with the trustee's own money. But what if the trustee mixes money from two different trusts? That would be different. Now, there are two innocent sets of beneficiaries, and equity cannot favour one trust unfairly over the other. So suppose a trustee takes £10,000 from Trust A and £20,000 from Trust B and uses the £30,000 to buy shares. Both trusts have contributed to the asset. They share proportionately. Trust A contributed 1/3, Trust B contributed 2/3. If the shares increase in value, both trusts share the increase in that same proportion. Now, if the shares fall in value, both share the loss in that same proportion, and this is known as pari passu, in other words, rateability. Now, if money from two trusts is paid into a mixed bank account and withdrawals are made, a different tracing rule may apply, and the traditional rule is from what's known as Clayton's case, and the rule is first in, first out. So the first money paid into the account is treated as the first money paid out. So if Trust A's money is paid in first and the first withdrawal is wasted, then sadly, Trust A is the one that would suffer the loss. However, courts are cautious about applying first in, first out if it produces injustice. And the rule can be displaced where it would be unfair, impossible to apply, or inconsistent with the party's intentions. In those cases, the court may instead allow the innocent trusts to share remaining assets proportionately. Again, the aim is to achieve some element of justice between innocent claimants. So let's now look at trust money, and trustee money. So sometimes all three are mixed, and in that situation, the approach is usually first, we push the trustee's money into dissipation as far as possible. So the trustee's own money is what is dissipated on those items that we cannot trace into. That follows the principle, of course, that everything is presumed against the wrongdoer. We then allocate remaining assets between the innocent trusts using the rules for competing innocent claimants. So the trustee suffers first, then the innocent trusts share what remains according to the appropriate tracing rules. Finally, these proprietary principles are not always limited to just trustees. Other fiduciaries can also be subject to proprietary claims. For example, if a company director steals company money and uses it to buy property, the company may trace into that property. The key is that a fiduciary relationship exists and property has been misappropriated. Now let's bring this all together. So proprietary claims are about following property. The court asks, where did the trust property go? If the original property still exists, we claim it. If it was exchanged for something else, we can trace into the substitute. If it was mixed with trustee money, equity favours the beneficiaries. If it was mixed with other trust money, equity tries to treat the innocent claimants fairly. If it was dissipated, proprietary recovery may not be possible. So what's Bowdie's bottom line here? Well, every proprietary claim starts with one question. Can the beneficiaries identify trust property or something that represents it. Remember, proprietary claims target property, not merely compensation. They are especially useful where the trustee is insolvent. Clean substitution allows beneficiaries to claim substitute assets, and mixed assets may give rise to proportionate claims or equitable liens. Re-Hallett and Re-Oatway help beneficiaries trace through mixed accounts, and the lowest intermediate balance limits some elements of tracing. Where two innocent trusts are involved, the court aims for fair sharing, and the big idea here is simple. If trust property can still be identified, equity may well help the beneficiaries to get it back. Thank you for watching this episode of Bowdie Shorts. There are further videos in our trust series available now via YouTube.